Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio, and today we're going to be talking about Realty Income Corp and then Seritage Growth Holdings, ticker symbol O, and then SRG. Properties, Seritage Growth Properties, that's right. And so ticker symbol SRG and then ticker symbol O, we're going to be kind of diving into these companies a little bit. I'm going to be the host asking the questions, and as always, Fabio is going to be the one with all of the wonderful answers. So without further ado, what are we looking at here today?
So I guess first we'll start with, do you want to start with O or Seritage Growth Properties? You let me know.
Let's start with O. Let's start with that one. Yeah.
So let's actually take a look at Realty Income's price movement. But what do you know about Realty Income before we begin, actually? I just want curious.
I know that they, at least by what you've said in the past, that they're one of like the cream of the crop REITs that you could possibly own right now. And that they are invested, correct me if I'm wrong, most heavily in commercial real estate.
Yes.
With mainly triple net leases. Correct?
Correct.
Yeah.
So let's actually show everyone the price movement. I guess we'll start with there as we always do. Austin's kind of alluded to it, that this is the cream of the crop when it comes to investing in REITs. And let's go over what maybe REITs are, I think. So REITs, for who may not know, are real estate investment trusts, and their sole purpose is to be pass-through entities. They are investment vehicles for which you can own commercial real estate property, large-scale residential property, but basically just real estate, okay? And there's almost a REIT for anything. There's actually such a diversity of REITs that we can probably make endless videos just on REITs themselves.
Yeah.
So Realty Income has actually outperformed the market since its inception. You'll actually see this if you go to their website. They always highlight it because it's something to actually, brag about. But one of the things that allows REITs to outperform especially when you don't consider taxes at the moment. But so if you have them in tax advantage account, we'll talk about that later. But REITs have been able to outperform themselves on a stock basis based on the fact that they are not taxed, right? REITs are not taxed. They're simply pass-through entities. And something a REIT must do is pay 90% of its taxable net income. We'll come back to that when we get to the model, but taxable net income to shareholders. So again, they're not taxed. So when they're getting the cash, they're able to compound it as efficiently as possible without the tax man actually getting a piece of the pie.
So now my question here is, what distinguishes Realty Income Corp from other REITs? How are they the cream of the crop? And then also too, how does one ascertain which REITs eventually get to the point of how they could be later classified as cream of the crop, if that makes sense?
Yeah. So basically the nature of Realty Income is simply put, they focus on triple net lease, which it means that the tenant is required to handle the property taxes, the maintenance of the property, and all the things that you may need a large workforce for. Realty Income doesn't have a large workforce, and they can do this because they're triple net lease structure. All triple net lease REITs will have this similar tendency. So I think the total employee count is like 200 something, and this company is almost a $40 billion company. So normally you'd be like, oh, 200 person company, that's not really that big of a business. It's not a tiny business, not a mom and pop, but it's not a $40 billion company. Well, that's because this REIT is a triple net lease REIT in particular, and the moat or the secret sauce is actually not really so secret, but you have to actually execute well. Okay. And we'll get to some advantages actually in the model, because I think that's important to talk about the advantages of size and the advantages of being
to kind of dig deeper into what you had just said there, that typically with triple net leases, this allows Realty Income Corp to kind of take a step back, which we're seeing reflected in their current employee numbers. And that's typically an indicator that you've indicated to me in the past by which you like to see REITs performing. Is that sort of a smell test that you apply to a lot of different REITs? Whereas if you're about to open a position in, let's say, a REIT in residential real estate, well, actually residential real estate, the triple net lease wouldn't make sense in that regard, then would it? It would only make sense in the commercial in the commercial sense. But basically the point that I'm making is the triple net lease something that you specifically look for when you're about to open a position in a REIT, or is it something that you like to just kind of see, but it's something that you're also willing to accept if it's not there?
The second one is true. Okay. I
Okay.
prefer it, but if it's not there, it depends on the type of properties. So there are REITs that are, data center REITs. There's REITs that are apartment REITs, trailer home REITs, etc. So with Realty Income, that has been part of their success. And it's also been acquiring properties that are accretive. And we'll get to that in a second. But let's actually go over, again, the price action more recently. So COVID happened and they never actually recovered to that price, right? So their high point is around $80. And they recently just finished an acquisition of VREIT. And this company, this merger per se, has been accretive already to the actual funds from operation, which is basically, you can think of that when I use that word, cash flows. And Realty Income going forward, we'll have to see how they're able to grow. If they're able to grow at the same amount of rates as they did in the past, I think that may be difficult, but it's not impossible.
Well,
They're definitely not
why
the
do you think
largest
it
REIT.
might be difficult in this? I mean, obviously, we never want to take the past and extrapolate that to the future, but why do you think that it might be difficult for Realty Income Corp to achieve or not exceed what they've grown in the past?
The bigger you are, the harder it is for you to find equally as many properties that are as good as the ones you have. So let's say Realty Income owns the best properties. Well, how big will they be? And when things start to get a little tighter, right? It gets a little harder to own more and more and more properties of equal quality without dipping into the lower quality stuff. So we can kind of go over the presentation. Remember, we like to go over the presentation to show what the company believes that investors should really think about. So they're highlighting what's better. And if we see this and we are not impressed, that's usually kind of be a red flag, because this is supposed to be like a highlight reel of the business.
It's like the sales pitch almost.
Exactly.
Yeah.
Yes. And this is known as the monthly dividend company. That they have actually the slogan for that, because they not exclusively, but some of the most unique companies, or very few companies, pay monthly dividends, and this is one of them. And their nature of being a real estate business kind of allows them to, or they're better suited to do this. Okay, that is what I'm trying to say. But anyways, they have their purpose, mission, values, vision. We don't really care about this per se. They are an S&P 500 company. They're basically saying we're very large. And then you can see here, this is their compound annual return rate, which is higher than the S&P 500. And then key takeaways. Okay, so just talking about it.
Okay, so to kind of draw from here right now, are you seeing anything that could indicate potentially a red flag to you right now? Because to me, this all looks great. This looks like exactly the kind of stuff I would want to see if I were approaching this to potentially invest in a REIT like this. But are you seeing any red flags here at the moment?
No, not at all.
Okay, cool.
So
what is like one of some of the biggest green flags that you're currently seeing here with what you're looking at?
Size, because we'll get to that in a second. Size is a good thing. Credit rating is a good thing. I think they are A- credit rating, and which I think is one of the highest among the REITs, by the way. And but the only thing that is concerning to me is the size, though, at the same time, because
that might result in slower growth. And then also too, credit ratings. What is the importance of, well, I mean, obviously I can kind of logically conclude what the importance of that is inside of a REIT, but what is the importance of a credit rating inside of REIT businesses, Fabio?
Well, REITs primarily raise capital through either debt financing or equity financing. And that's how they are going to get more properties, right? And if they can get better terms on that debt, then they can have more accretive acquisitions, because at the end of the day, you have to measure the delta between the cap rate of the property and the rate of the debt or capital that they use to acquire it. All right, so we get that. We'll talk more about that when we get to cost of capital and the model. They want to also highlight that they're now geographically diversifying. So they have properties now in the UK, Spain, and the United States. And they want to highlight, for example, also the credit rating of, oh, you see, I was right. Yeah, it's A- credit rating, but investment grade clients. So this is the amount of clients that have an investment grade rating. Investment grade means triple B or and above. Okay. So why is that important? Because supposedly, in theory, higher credit rating means higher likelihood of getting paid, higher likelihood of getting your rent, right? And so the market appreciates and will assign a higher multiple if the property portfolio is made up of higher credit rating tenants.
So I kind of have a question now too.
Go for it.
Is this A- credit rating? Are these credit ratings standard across the entire globe, or is it only exclusive to the United States and each country has its own specific way of measuring credit?
Well, it actually has to do with the companies that measure it. So there's Standard and Poor's, which is actually S&P, right? Standard and Poor's, then Moody's, right? And then there's one more. I always forget the name of the last one. But anyway, there's one more major one. And Moody's and S&P, they're the ones actually being highlighted by Realty Income. They're basically the same, A3 and A-. That's the same. It's more or less the same. And they just have different ways of saying it. So S&P has a very easy, what everyone thinks of when they think a AAA credit rating, triple B, all of that. So when I say triple B, I'm referring to S&P's credit rating, and they are the major authorities on credit rating. So when people usually mention credit ratings, they're talking about those companies.
Okay, so now that we have that sort of out of the way too, you mentioned earlier that typically they will buy properties through debt or equity. Do we typically tend to see a capital strategy favored over another? So for instance, do REITs typically tend to issue equity to acquire these properties, or do they tend to issue debt to acquire these properties? If so, if they tend to issue equity, is dilution something here that would bother you in this instance? Or is there sort of a nuance to this dilution here?
No. Yeah, it's nuanced to the dilution because you want to make sure that the cost of the equity, for example, we can take the dividend rate. And let's say for argument's sake, the dividend is going to be 3%. And then they find a property that's yielding a cap rate, right? So cap rate is simply the yield of the property. So they have a cap rate of 5%.
I was about to ask again, just like a quick definition of what cap rate is for maybe some of our audience who might not know out there.
Yeah. So if in a formula basis, you take the rent divided by the purchase price of the property. It's very simple.
Perfect.
Yep. And then you take the cap rate and then the cost of the capital that you acquire. So let's say the dividend of the company is 3% and you issue a bunch of shares yielding 3%. The delta between that is 2%. So 2% is accretive to the business itself. So in that case, the acquisition of the new property is good for me. Now you may say that you would have preferred debt because debt is fixed. And then after the debt is gone, it's gone. And then the equity will be there forever. That's a fair argument. Okay. But at the end of the day, we want to make sure they're using the lowest cost of capital. And the high credit rating allows the debt to be an option, right? So they don't have to always put their hand in the cookie jar for equity. They can use debt, but they have everything available to them. And you want the REIT to have as many tools as possible. I want to highlight something. This is interesting. The dividend has only grown at 4.3% since 1995, which is about their IPO. Yet the stock has returned 15%. So this tells me that the company has actually become more expensive over time. So a lot of the returns can be attributed to the re-rating of the stock. Well, and I think I'm almost certain that the return rate of the company includes the dividend itself, not capital appreciation. I don't think it includes dividend reinvestment. I think if you included dividend reinvestment, it would have been even greater. But I'm fairly certain that the returns are largely attributable to the re-rating of the stock. Basically, the market is recognizing that this company is a great company and they're willing to pay more for it relative to each dollar coming in.
Yeah, because I was about to ask too, especially in regards to this. What has the track record? I mean, obviously this is reflected, so I already know the answer to this, but maybe you can kind of emphasize and maybe explain a little bit more what the track record has been of the properties that Realty Income Corp has been acquiring? And then also too, have they been primarily doing this through debt? And then to kind of answer the question that I had earlier about dilution, let's say that they were to dilute you at a rate of 5% per year. If this property was returning, I don't know, 8% per year, then this wouldn't be something that would bother you. I'm just trying to make sense of how this
Oh,
kind of works,
no,
because it's a difference in thought to how I typically think when it
it, ha-
comes to dilution.
it has nothing to do with the percent of dilution that occurs. It has everything to do with the cost of the equity.
Okay.
So let's say I issue $1 billion worth of stock, and that's 5% dilution. I'll say this right now. You should not care about the dilution percentage of the business as it pertains to acquisition of new properties. It's a separate argument. All right. So let's say I raise $1 billion and then I go buy $1 billion worth of properties. Let's say the stock I issued, remember that 5% stock I issued, let's say that yields, right? The dividend yield is about 6%, right? And then I go find properties again that are yielding 7%. All right. Well, the delta between that is 1%. You see, we don't care as long as it's $1 billion in total, right? We issued $1 billion worth of shares to buy $1 billion worth of property with a delta of 1%. Now that doesn't sound too good. And let's say that the dividend yield is now 3%. And that we find the same property or maybe a property of 6%, then you have a higher delta, you have a higher spread. Okay. So it's not about the percent dilution, it's about the cost of that equity that we are diluting, right?
Okay.
Because presumably
income
each dollar
being brought
used
in
will be. Yes.
Okay.
Mhm.
Okay. So, okay. Now I actually understand that. Perfect. All right. Please continue with this
So I don't
wonderful
think
presentation.
we'll go over the entire presentation because it's very long. It's a very long,
Yeah.
extensive presentation, but I just want to basically highlight or just say that this company is of very high quality in the REIT space, and it's very
Mhm.
popular. It's actually one of the most popular stocks among dividend investors, and for the good reason. I want to say, actually, I'll add this risk. Remember to ask me about the macro risk to REITs at the end after I talk about Seritage.
Yep.
So now I guess we'll move on to Seritage. And what do you know about Seritage? So I asked you about but what about SRG?
I know that Seritage is what is left of Sears after bankruptcy. And I also know that Seritage 2 has been kind of struggling as of late, but I think there's a case for them to sort of be in the up and up. I think investor sentiment is turning positive, but that's about all I know about Seritage.
Okay, so Seritage, let me just say, it's kind of like the dumpster stock of the REIT market.
Funny.
Not that it is trash itself. It's kind of like a dumpster dive. So there are some notable super investors, that's what we'll call them, that have invested in this company, and they see some potential. So we're going to try to see if we can find that potential today, and we'll start by first talking about the price action and kind of get an outlay of what we're looking at. All right. And again, guys, this is raw, so we're doing this in real time. And we're going to see here. Okay. So Seritage, since
boy.
IPO, they're
What
not doing
happened
so
there?
hot.
Yeah.
Probably something, but this was the pandemic. This was the drop in the pandemic. They just never recovered. So if you think, for example, by some strange logic, you might say they're going to go back to here for whatever reason. And then I don't know what that would be a pretty sizable jump. Okay. Let's just say that more than triple your money. And then, however, is that feasible? What's their plan? How do they plan to get there? What's really going on? Why are they not rising in tandem with the rest of the market? All right. Well, let's take a look at Seritage's presentation and see what they highlight to us and tell us. Mm-hmm.
I actually have a question here, just to cut in here for a quick second. Seritage Growth Properties Class A, this would imply, at least to me, I don't know for certain, that there's multiple classes of stock within this particular REIT itself. Now, I kind of have a question here. When it comes to a REIT and you see multiple different classes of stock, does this sort of have the same implications that, let's say, common stock in a company like Apple would have?
Well, yeah, it's class.
So voting rights
mm-hmm.
and economic interests. And then if so, is that typically the delineation between the two of them? If you have Class A and Class B, it's typically voting rights as well when it comes to, and then what are you voting on when it comes to a REIT? Are you voting on them potentially acquiring more properties? Are you voting on new management? Like what does that typically entail?
You're well, for voting rights, it's voting on management, right? It's voting on
Mhm.
management, key decisions, stuff like that. You just want to make sure the economic interest is the same and there's no difference in treatment as regards to that. But with Seritage growth, we'll see in the model whether or not there are dual class of stock. But let's take a look actually at the PowerPoint presentation and kind of see what management wants to highlight to us. So this is kind of like an initial idea of their portfolio. We see triple net lease. We see this new built for rent concept that they're switching to, residential, office, life science, etc. So all these little fancy things, and we want to make sure that they have. I hope these are actual pictures of their properties because this one's actually nice. And then we want to see, okay, this is some fluff talk by management targeting strategic partnerships. What does that mean? Accretive capital source to unlock value. See, I told you that they need to do stuff that's accretive, but that could be just a key word. Accretive capital. What does that mean? What's your plan? All right, so this is the woman that's going to make it happen. She's the former CEO of Oslam Properties, so she's supposedly experienced, and she's fairly new. Actually, she just came in 2021. And then now chair of board of directors. Okay, so I don't really care.
All right. Are you seeing any red flags or green flags right off the bat?
A lot
Red
of
flags.
buzzwords.
Okay.
Not really. Oh, here's a red flag. A lot of exposure to SoCal, California
Oh boy.
hubs that I wouldn't really be too kind on, because yeah, well, okay, they have Miami and Tampa, which is
Yeah.
nice. Chicago, New
Yeah.
York's okay. New York's okay, but yeah, these areas are not.
California's cringe in this instance.
Yeah, there's a lot of
Yeah.
risk.
Yeah.
Arizona, so that's Phoenix, Arizona, so that's good. So basically, I have it in like big city hubs, but like some of the big cities are, you know, Chicago, New York, yeah, San Francisco, and I think that's San Diego or Los Angeles.
No, that's LA. Yeah, that's the
That's
LA
LA.
area.
Okay,
Yeah.
cool. Yeah, LA. It's whatever.
Hmm.
All right, so I'm not stoked by their portfolio because this is showing concentration, and the larger the circle, the more the concentration. That's
Yeah.
why. Okay, so to highlight
So
everyone, that's why I'm kind of going
concentrated mainly
concentration.
in California. And now I have to ask, what are like the risks present with real estate in California? Just a preliminary overview of maybe some of them that kind of makes
Volatility,
you. Yep.
volatility of policy. Also, it's California is the state that was the primary growth driver for the United States in the past, but going forward, what we see is that it's not going to be.
Yeah.
And that's just a cycle of growth and decay. So California is now in its decay phase. It may return to
So
growth one day, but for now, it's stifled.
okay.
Right. And I'll
So
just keep
in
it at
this
that.
instance, yeah, California is cringe. Okay, cool.
Yeah, I'd prefer the growing markets of Texas and Florida. I want the next California, the
Yeah.
ones that are up and coming, which is Texas and Florida. Okay, so this is what's okay. So this is kind of interesting because the market cap's only 500 million. So I see people are probably judging it for its book value. Yep. Okay. So national portfolio, net debt. So right off
Okay.
the bat,
So
they're trading below book value.
all right.
Mhm.
Okay. Yeah, that's what I was about to ask because you had a light bulb moment, and I wanted to pull that, see what that light bulb moment was. But okay, so they're trading below book value. So in that instance, is this a green flag or is there more added nuance to this? Because I mean, immediately, like a lot of people would just see that and be like, "Oh, they're trading beneath book value," which might explain. I'm not going to say for certain, but it might explain why the super investors probably may have potentially invested in this. But is there more of an added nuance here that I might be overlooking right now?
There will be there's a reason. The market just doesn't give you something for free. There's a reason.
Mhm.
Now, those reasons might be overblown, overlooked, etc. That's a different thing, but there are reasons as to why it's trading below book value. And we'll kind of get to that. I'm kind of thinking the quality of the properties is not that good. Okay. Okay. I don't really care. Okay. All right. So where are we at? So they're highlighting a flexive, efficient capital, buzzwords. Berkshire Hathaway. Oh, love to put Warren Buffett in the same slide as you, buzzword. Has approval rights over.
all over all sales.
Okay. So basically
What does that even mean?
He has to approve the sale of all the properties.
Okay.
Amend loan, maybe blah, 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 whatever. Flexible, efficient capital.
Okay.
Hmm.
Allows company to utilize cash flows to best maximize business. No complicated cash management requirements. Okay. So where my mind immediately jumps to triple net leases, how many are we looking at here? Is this an employee like business? We're kind of seeing sort of a similar situation to Realty Income Corp, or is this
No, do not. We can't put them in the same league.
Yeah.
We're putting them together just because they're REITs and they were both requested.
Yeah.
Which, by the way, if you have any other requests, comment down below or go to our
Yep.
website and capitalmindset.org and file the request
Yep.
there. So we're putting them both together because, again, they're both REITs.
Mhm.
I would not put them together in the same category of quality. But okay, so here's what I'm saying. If whatever is going on here, whatever your thesis is, if it goes right, it's going to be really good. All right. It's going to be a good investment. So that's probably what the super investors are looking at. If it goes right, it'll be good. However, if it goes wrong, well, there's probably a higher likelihood that it does go wrong. And that's why it's priced this way. Okay. Or at least the market believes that. Now, let's actually go into the model. So I think to keep things continuous, we'll go with SRG first.
Just to kind of ask, what are some things that could potentially go wrong within SRG?
Execution risk. The property qualities are not that good. And I'm not even talking about the macro because I'll talk to about the macro after Realty Income. So let's say for SRG, what rate of return are we going to imply? I
15%.
No, I think for the risks involved, I would require a 20% rate of return. So based on just that, let me make sure the model's set to REIT. It is okay, because we have to calculate things a little differently with REITs and stocks. So the model has a feature where I say yes, and now it behaves differently. It does its own thing now where we're talking about REITs, and it knows we're talking about REITs.
Okay. So okay, know that I'm going to ask this question now. What are some of the key differences in calculating these two things between a REIT and then also a equity, and let's say for, again, Apple?
Okay, so Apple has different nature of its business that you will calculate the cash flows differently. Okay, I know I'm kind of copying out, but I don't want to make a video just about the accounting of that. But the cash flows will be slightly different. But for the most part, we're still trying to tap the same thing. We're trying to get the same thing out of the financial statements, which are the cash flows. Right? Cash is king, right? So here I'm going to assume the same dilution rate of -4%. So we're going to be losing those shares. And from that, I'm going to then assume some growth rates. So we haven't had any growth rate over the past couple years, but I'm just going to presume them myself. All right. And the way I'll kind of do that is the cash flows are declining. Well, that's not good. So
yeah, that's not good at all.
No. So we will then assume our own, and let's do, for argument's sake, let's see what we would need for us to get our return. All right. That's what we're just going to do now. And then from here, you see, it's not the end of the world. We're still playing around, and we're still going to see, okay, what can I expect? Right. Okay. So let's put in a 10% rate of a growth rate in cash flows. Well, that's not going to do the trick. Let's say a 20% growth in cash flows.
Oh boy. Yeah.
Well, that's
so
not going to do the trick.
Basically, to summarize, like, we have to make some pretty heavy assumptions in growth and cash
30%.
flows in order to justify current prices for it.
There we go.
40%.
So now I know that it's between 30 and 40% that I have to assume in order to get what I want. Right. So I have to assume a pretty hefty growth rate. And I need to know, for example, what is the future potential of these properties, right? Because I think I'm actually being fairly conservative here. Oh, yeah. I'm giving it the max, right? I'm pretty much pushing it to
So
its limit.
how do you even go about measuring the future potential of these properties here?
Well,
How would
I
you
go off of
even attempt to
historical.
measure?
That's all I'm doing, and I'm being
Okay.
very aggressive, not conservative. I'm being very aggressive. I'm being very
Mhm.
favorable to Seritage. I'm basically saying they're going to be at the best ever, which is 25% of the rental rates. They're going to keep as cash, right? They're going to keep as
Mhm.
cash at the end of the day, and then that is about the as best as they've ever done. They could do better, but that's an assumption you'll have to make. They're going to do better than ever before. Okay. So uh, let's kind of try to pinpoint together where we have to. Okay. So right there, we found it 35%. So I have to assume a 35% rate growth rate in the cash flows, assuming that they will go back to normal and achieve the highest that they've ever done in terms of cash flows, right? As a percentage of their rents. Okay. So from there, then I'm assuming a growth rate in those cash flows of 40% once that happens, right? And then, or 40, sorry, 10 to 35%, or sorry, 10 to 40%, because 40% is the highest. And the only one that comes out being a buy, I'll count the 35 because we're basically there, but 35 and 40%. Those assumptions are extraordinarily high. They're really, really high. Okay. I would not be comfortable with that. Now, I don't know what everyone's seeing, these investors that they're investing in. I don't know what they're seeing. Now, they could be seeing something that I don't. They could know that the company's going to grow much faster than this. I don't know how. They could think that the cash flows coming out at the end are going to be even higher margin than ever before. I don't know. A variety of things that I could just be overlooking, right?
Okay. Yeah. And
But
so,
I wouldn't
no,
I wouldn't be investing in this for sure.
okay.
100%.
As I continue to look through here, so to basically summarize everything that you said, even you have to assume a lot to go right, and a lot of your assumptions are resting on like ultra aggressive, basically. Like
Yes.
you're assuming that this company is going to be cream of the crop, management will execute everything perfectly faithfully, and then even then, there's still, apart from the uncertainty that exists there, a greater uncertainty within this respective area. Okay, so now let's kind of move to the key stats. I'm seeing negatives everywhere.
Yeah, because they're not
What
making
is
any
the
money right now.
story? Yeah, yeah. But
That's
what
it.
is the story that this is pretty much telling you? Just exactly that.
Yeah, they're not making any money.
Okay, perfect. We
Ignore
move
the
on from
dividend
here.
payout of negative 4.5%. It's
Mhm.
because they had this dividend yield that it's still counting in, but they didn't have the cash to pay it. All
Yeah,
right. So, why would they do that? All right. So,
interesting. The Altman Z score also said too that it's at risk of bankruptcy there. So I just thought I'd point that out.
well, the Altman
But
Z score saying it, and then my own other measure is saying yes.
yeah,
So my
wow.
other measure is returning yes. And so it is telling me this is a very scary business.
Hmm.
Very
Yeah.
scary. All right. So let's go to realty income. I already like pre-filled it to save time for everyone. But this one, we see the analyst buy rating, right? And then a price target of 79, implying 14.9% upside.
Mhm.
So I want to highlight to everyone that if for example, we want to assume these negative this negative dilution, right? It's not a buy. However, it depends on how you look at it. For example, like I said, the returns that they implied on their website, I'm pretty sure did not include reinvested dividends. They included dividends, but not reinvested dividends. And you're not supposed to, obviously discount dividends, but you can measure. There is a way to mathematically measure. I won't actually go over that because I will actually reveal a little secret that apparently one channel hasn't figured out yet, but it's math. Okay.
Hmm.
At the end of the day. And what we can do is we can account for, in a specific way, we can account for the reduction and the increase in ownership that we experience over time. And that's what we're going to do by saying we're going to reinvest the dividends. And let's say we reinvest the dividends, we allow for the dilution to occur. By the way, this dilution of negative 9.22% is simply because of an acquisition they just made with VIA REIT. So VE REIT, right? They just issued a bunch of shares to merge with that company. So that's not normal. Okay. Excluding that event, I expect it to be around negative 4%. However, The dividend, if you were to invest in now, is going to be about that 4%. So I'll just say no. Okay. No inclusion of buybacks or inclusion of new issuance. So with that, I can therefore assume, look what I can assume with a 0% growth, right, in the cash flows, $48 is what I would need. And that would give me my desired rate of return of 20%. I will say that during the pandemic, which we'll show here.
Yeah, I was about to ask that too.
This is actually where I actually managed to get some Realty income, because I was paying attention to Realty income for a while, and I didn't get it exactly at the bottom, but my cost basis is about $45 per share.
Wow.
And I haven't mentioned her before, but my sister, she has a decent amount of Realty income in her portfolio at, I think, a slightly lower cost basis than that, which is actually wonderful. And Realty income actually in my retirement account is a significant part of my portfolio. And it's in my retirement account for the reasons I mentioned before, because it's tax advantageous to put a REIT in there, because now the dividends are not excluded from my ordinary income and I don't have to pay that. And then I get the full benefits of the entity doesn't pay taxes and neither do I. So I get the full compounding effects. And each time the monthly dividend comes in, I just reinvest it. It's on autopilot at this point. And I consider it my little real estate fund, right? That's so full disclosure. I'm long Realty income.
Yeah, I don't own a position in any of these, but yeah, okay. It's funny even just taking a look at this versus SRG and just seeing the complete difference in story that I'm
quality.
Obviously, yeah, quality, especially that I'm really reading here. So
But
let's kind of navigate to the key ratios. I actually have some legitimate questions for this.
I hope all your questions are legitimate.
Yes. So my question here is in regards to let's say the debt ratio here. Is this like a favorable debt ratio that you're seeing here, or is debt ratio not even really something that you pay attention to overly within REITs?
No, it's actually quite good relative to a REIT, because REITs, it shows the conservativeness of the balance sheet. You want to know why they have a high credit rating for REITs? That's why.
Okay.
Yeah. See, you can derive a story from the numbers, which is what I try to preach in these videos all the time. As an investor or as a finance enthusiast, you must derive stories from the numbers, not simply just look at fixed numbers and say, oh, that's good. That's up. Good. You want to derive a story from it. And then that's kind of telling me, okay, so their credit rating, that's why it's good, right? Looking right there. And then, I mean, you need that added context that REITs, they may be more dependent on debt, but and then you kind of know off the top of your head by looking at so many over time that that's actually not that bad. And then it makes sense. You put two and two together and you're like, oh, that's why they have a good credit rating for REITs.
Okay. And then also here too, sort of looking at the operating profit margin as well. I would assume, at least by what I'm seeing, that this is an exceptionally good number. Is this typically okay? So yeah, which actually makes sense given that nuance why this number is so high in this instance. So if I was seeing a REIT that did not have a triple net lease structure, I would see a lower operating profit margin because they would be incurring more expenses on their income statement. Okay,
but we have to remember,
those were like yes.
We have to remember that with REITs, you don't want to be looking at the GAAP net income. You want to be looking at the cash flows relative to the rentals, but we call that AFFO or FFO, but that's up to your preference.
Okay. Would you just kind of explain those in teeny tiny detail? Yes.
Very simply, that's the cash flows of a REIT. All right. That's the cash flows of a REIT. So you want to know free cash flow of a company. Well, free cash flow of a REIT is AFFO or FFO. And adjusted funds from operations is considered to be, I think, the more conservative one. It's slightly more conservative. And then, but you can use either or. I've seen people who are considered REIT experts say either or is fine. You just don't want to use net income or the typical calculation of cash flows. All right. So when we look at the earnings quality, look at that. Oh my gosh. Wow. High quality.
And beautiful. I always ask, what is earnings quality? It's an exclusive metric to Capital Mindset.
It's not. So, well, yeah, it's not exclusive. It's not like
no, but it's exclusive. Come on.
Yeah, okay. So it measures the it's like a grading of the management and how they've done over time, their accounting. But as we can see going down, the free cash flow per share, do not pay attention to that actually, because that's not actually the same as the actual cash flows. But I want to highlight it's not so far away. Okay, it's not incredibly far away, but the EPS, right? That's really far away from the AFFO, or funds from operations. So the free cash flow per share is close enough, but it's not really there.
So
Mhm.
wouldn't that then actually provide a strategy, because REITs have to pay out 90% of their net income to shareholders, correct? So wouldn't this exactly provide a strategy? Is there some kind of like, am I making sense with what I'm saying? Doesn't this provide a strategy by which they could pay out less to shareholders here, and then that would be
And keep
more
more money to invest in the business? Yes,
exactly
because they
that.
only have to
Okay.
pay out what's taxable income, not actually what
Okay.
the cash flows in. But the taxable income can be lowered because of depreciation, amortization, stuff like that,
Yes.
non-cash expenses. Okay, so look at that book value per share. So
Wow.
yeah, so my cost basis again is it's about yeah 45-ish around there, and so I'm not too far away from actually the book value, and the book value is going up and up and up, which tells you that's a smell test of accretive acquisitions,
Hmm.
creative
Okay.
acquisitions, and that the real estate portfolio is growing in value faster than their liabilities. All right, so we don't care about inventory ratios, so we're going to skip those. But
Perfect.
I want to
Going
highlight
back to the
how I don't want to poo-poo on SRG, but you can see here SRG
book
earnings
value per
quality.
share is going down per year.
Yeah, that's the other thing. So we don't care about activity ratios. I have no idea what the thesis is, because book value per share is going down, so they should be going the opposite direction. Earnings quality. So my model is actually saying the management poo poo. Uh, not that they're poo poo, but you know what I mean. And then you can see right here the balance sheet ain't so good,
Ooh.
ain't so good.
Yeah.
And then you can see operating margins.
Oh
So
my goodness.
yeah, so actually the operating margins are really close to their cash flow margins, or the AFFO margins. And so remember that the model was saying that they maxed out at 25% at one point.
Yeah.
So it's not too far away. I mean, it actually in the operating margins, they maxed out at 26. So operating margin is sometimes a good actual more indicator of the AFFO. It can be, not always. Depends. Nuance depends. All right.
Hmm.
So operating margins pretty good back then, but terrible compared to realty income, obviously. And they've never really they seem to be going through some troubles.
So did all of these super investors then invest in this time period when it was at least quote unquote favorable in this instance here?
I don't know exactly when those super investors invested in, but
Yeah.
if I had to guess, maybe they did it in like 2019.
Yeah. Because if I'm looking at this, giving
I
them the
hope they did
benefit
it.
of the doubt, I'm trying to find at least that one thing that allows me to be like, okay, I can at least see, I can see the thesis here. But right now, everything that I'm seeing, I'm a little, ooh,
Yeah,
you know.
I hope they didn't. I hope they invested it down here, because if they did invest it down here, I mean, some of our viewers might know that, and they might say, well, they invested around this time, because they'd
Yeah.
be up a lot. It was a good trade investment, whatever you want to call it, from here to here.
Hmm.
But I don't know, man. It's confusing. I mean, they actually, I'll say this, you would have done better buying this than buying when I bought O. Okay. So my investment in O did worse than buying this thing down here. But I'm more comfortable owning O for a very long period of time than I will be owning this. Okay.
Yeah. Okay. So any more comments before I bring up the final two questions regarding this video? And then I wrap up the video. Any more comments about O or SRG from the
Nope.
model
As
perspective?
individual businesses or model, nope. I'm pretty
All
much.
right. So now I'm going to bring up sort of outside of these, but more so to REITs in general. And my first question is, what are some macro risks present with REITs? And then my second question is, what are the tax advantages of owning REITs? And as always, we are not licensed or registered financial
Yeah.
advisors. This is, entertainment purposes only. But, this is just, two guys having a conversation about REITs. So,
So essentially, the I'll go over the tax advantages first, and
mhm.
then I'll go over kind of in greater detail the other thing, but because I wanted to pull up a chart for that, but I have it now. So the tax advantages of REITs pretty much goes towards the fact that the entity is a pass-through entity. So again, it doesn't pay any taxes, and the taxes are put upon you as the owner of the REIT. So what that allows the business to do is actually fully optimize and compound the cash that it's bringing in. And that is basically why mathematically it's very probable that REITs as an index will outperform C Corps, because C Corps have to pay right now, as of now, 21%, but they used to pay more. So in aggregate, they're having to pay out more to the government than the REITs, which don't have to pay out anything because of what REITs are. REITs are pass-through entities. It's not that no one's paying the tax. And remember that the C Corps, there's that thing of double taxation. So the C Corp pays the tax rate, and then you pay the tax rate as well. In the REITs, they don't pay the tax rate. All the tax just goes to you. So then when people measure the return of the index of REITs, they're forgetting to also take into account taxation. When they take into account taxation, then it kind of gets to more normal levels. However, if you put a REIT into a tax advantage account, then things get a little crazier. And I'm speaking for Americans only. Again, that's not tax advice in and of itself. You have to go consult your licensed tax professional who knows your specific situation.
And this is for entertainment purposes only.
Yeah.
Entertainment purposes only.
For me personally, I own REITs only in my tax advantage account, specifically so that I can take advantage of the tax sheltering. And then that way the entity doesn't pay taxes and neither do I. So I get the best of both worlds in that sense.
Okay,
and I allow for the maximum compounding.
Okay. So, and the reason why you also own it in a tax advantaged account, maybe for some newer people who might not understand, is because when the dividend is paid out to you, it's paid in the form of ordinary income.
Oh, yes.
And when you put it into a tax advantaged account, you don't have tax on that ordinary income. So in essence, you're allowing that to compound at a greater rate more and more as the years go by, further and further on. Now, again, this is not financial advice, just for entertainment purposes, but that's really interesting. So now what I'm extrapolating this story from here is that basically taxes play a huge role in your success as an investor. So you want to have a good idea and understanding of the way taxes work within your specific country, state, jurisdiction, et cetera, and so forth. And because of this, you are not really lumping two things in the same category and just saying, okay, like all this goes into this tax advantage account, because the inverse might be true too. Are there some investments that you would make personally that you wouldn't put in a tax advantaged account? And if so, what might be some of those investments? Again, entertainment purposes only. But
for me, I would be hard pressed to put, for example, if I was, investing in an index fund for a long period of time, I wouldn't really put those into a tax advantage account. That kind of defeats a lot of the purpose.
That to me defies at least like common sentiment that I typically hear. Why would you not put that into a tax advantaged account?
By the way, Austin's asking this wrong. We haven't really discussed this, but
yeah.
So the reason why I wouldn't do it, that doesn't mean you shouldn't do it, but I wouldn't do it, is because when I look at an index fund, for example, I think of their purpose as being already tax advantageous for the reason that you basically buy the asset and you just don't sell it. You buy the asset, you don't sell it. It reshuffles here and there based on how index funds are created. We can do a video actually on how index funds are created. You guys can leave a comment down below and I'll actually walk you guys through it. And then I'll walk you guys through how they do some of the math for the PEs. Remember that?
Well, also there's a lot of index funds that there's a lot of nefarious people that have taken advantage of people just by using the word index fund and have done a lot of.
Oh, that's a separate comment. So
yeah. But we can include that in the video. If you guys want to see it, please leave the comment below and we will walk through in depth into that. But please continue.
So with index funds, you buy the asset, and again, you're not supposed to sell it. So that's the nature of the instrument. It has a bunch of stocks within it, and then it can reshuffle on its own, but then you don't actually face those consequences per se. So you can just hold and you just leave it. Of course, a lot of ETFs do pay you the dividends, and you may have to pay. There's a tax consequence for that, but uh, the point of, for example, owning individual stocks and tax advantage accounts is you mitigate the tax consequences by buying and selling, right? With the index fund, you can play the strategy of buy and hold forever, and then you don't need a tax advantage account to do that. You're then just fighting over that when you eventually do sell and you pay those long-term capital gains. You may, want to shield yourself from that. That's what you're really doing when you put in a tax advantage account. Or you could also think of it as maybe securing yourself from tax raises in the future. So if you think the government will raise taxes in the future, you're kind of saying, oh, well, I'm not going to participate in that. You can't raise the taxes on me, etc. And then to answer your other question, so we can wrap this up, the macro risks with REITs.
Yeah.
So basically, they're actually heavily connected to the interest rate environment. So interest rates have been going down since about the 1980s. So right now, if you are, what is that, in your 40s, right? You have been living through what is arguably a very unique time period. Okay. And I mean, hopefully it can go back a little bit more, but we did have high interest rates before, but you are living through a fairly unique time period in which interest rates were up close to 20% per year at one point in time, and now have been if you draw a trend line from here, it's declining and declining and declining. So from here, what do you think has done really well? Well, assets that are inverse to interest rates. Real estate is one of those. Real estate is inversely correlated with interest rates because a lot of real estate is bought and sold with debt. So if debt becomes more expensive, guess what has to happen to real estate? Has to reflect the nature of the market. If it becomes more expensive to buy, can more people borrow to buy? No, less people can borrow to buy. And therefore, you're sucking out liquidity from the market. So that's less money available to buy the real estate. Therefore, the prices have to come down. Cap rates have to come up instead of coming down. And you kind of probably have noticed this, interest rates collapsing again and real estate rising. It's no accident. That's part of the course. So if you think interest rates are going to rise, I have my own conversation about that. Very interesting opinions. I in my opinion, it's a very interesting opinions. But I may or may not think that that's not really a risk for various reasons. Some good, some bad. All right. And yeah, so that's basically the macro risk that you have to deal with interest rates. If interest rates are presumably going to rise, remember that interest rates also compete with REITs because a lot of retirees use REITs as fixed income securities in some form or fashion because it's real estate. So that's kind of a separate asset class away from traditional stocks. And then, but bonds are no longer yielding anything. So a lot of retirees don't like to use them, but that's basically where I'll end.
So the macro risk that is present with REITs right now is that interest rates go up, the cost of debt becomes higher.
Yep.
And then therefore the cost to purchase properties becomes higher. And that would be reflected, sort of piecing this together to make sure that I'm getting this, that would be reflected in the operating income. It would be reflected in cash flows, which would then be reflected in your investment returns, which is then reflected in the dividend and everything.
All
it's
the
just
way.
There's a nice little trickle down effect happening here. All right. Well, do you have any closing thoughts before I wrap up the show here today?
I think we've covered everything we wanted to. Yeah.
All right. Wonderful. Well, this is the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. If you've liked what you've seen here today, please be sure to share the video. It really, 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 really helps out the channel. And then please be sure to like, comment, and subscribe and visit our website at capitalmindset.org. And take care, guys.